Hello everyone, this side Mehak, and here I'm going to discuss the topic that is a saving as a foundation of microfinance. So, saving is a foundation of microfinance. It is because it builds the financial stability, how low income individual and communities regular saving help to people manage their emergency, invest in the small business and reduce the dependence on the high interest loan. For microfinance institution, saving create a stable pool for the funds and that can use to provide the credit to others also, making the system self-sustainable. In simple terms, saving promotes the discipline, financial security, and long-term economic empowerment, which core of which is the core goal of the macrofinance. So now let me discuss the case studies. So our first case studies is vulnerability to security. So our topic for the first case study is vulnerability to security. It is the case study which is related to Savitri, which is living in a poor village and not having such a financial condition. In case shows that the house saving can transform financial vulnerability into stability. So Savitri, a daily wage worker, had irregular income and no safety net. However, emergencies helped. She had to depend on the high interest loan from the moneylender, which pushed her deeper into the poverty. After joining a self-help group and a saving a small amount every week, that is, she used to save only 50 rupees, a small amount, very small amount per week. This reduces the dependency on the high debt and improve the financial confidence. Irregular saving create the discipline, reliance and the security, proving that the saving are more powerful than the credit for the long term stability. Before saving, she has to face the money lender for the she is depend on the money lender for the high debt and paying the high interest on the debt, so which cause deeper into the poverty. And after that, so it increases the weekly discipline, emergency buffer, reduces the depend on money lender, improved reliance. So this is all about our first case study. Now I'm going to discuss the case study 2, that is compulsory saving, discipline on coercion. So a question arises, if the person is compulsory saving their money, so it is a question for the discipline or coercion. So let me discuss. This case studies is a model where the group member must have the fixed amount to qualify for loans. The objective of the compulsory saving is to build the repayment discipline and create risk caution, strengthen group accountability, and act as a quasi collateral for lenders. Because saving are mandatory and repayment rate improve the financial behavior become structured. However, the limitation that is that savings are not fully vulnerable. Extremely poor members are the feel pressure, and if the system is not explained properly, it can reduce the trust. So while compulsory saving protect the institution and promote discipline, they raise the ethical concern about the financial illusion and borrower autonomy. So what is the objective of the compulsory saving? Is the building the repayment discipline, create risk cohesion, strengthen group accountability, is all are the objectives. So this is the whole case study about the compulsory saving. Hello. So let me discuss the case study 3. What is the case study 3 says that the vulnerability saving, building trust and illusion. So what is voluntary saving? So this case focus on the voluntary saving where borrowers deposit flexible amount based on their income patterns. There is no fixed commitment and they can withdraw funds when they need it. So this flexibility build trust because borrower feel respected and in control. So in this case, the borrower have an freedom to deposit any amount which they are having and deposit for the savings, and whenever they need it they can withdraw that amount whenever they need it. So voluntary saving promote the financial illusion by adapting to irregular income common in the informed work. They encourages habit formation through the small recurring deposit, improve liquidity management and reduces the dependency on high interest loan. By giving people choice, the model increase long-term engagement and strengthen the relationship between institution and the borrower. Now, I'm going to discuss the case study 4, that is behavioral finance in action. This case explains how behavioral finance principle improve the saving behavior. Metal accounting. Metal accounting flows the people to separate money for the specific goal like education, marriage, business investment. This creates the psychological commitment and reduces the impulsive spending. Metal accounting, creating separate saving pool for the specific life goals. It is the risk mitigation. Emergency saving for the health shock provide the immediate liquidity, reduce the need of the high interest emergency loan during crisis. So there are some kind of behavioral changes we can see in the these kind of saving. That goal based account create psychological commitment that improve the emotion and the financial security through the structure planning. So goal based application is on the education expenses, marriage saving, asset purchase, business investment and so on. For the emergency protection, health shock, immediate liquidity and low risk borrowing, emotional security and so on. So emergency saving is very helpful in this kind of emergency for the emergency situation. So it is a goal based emergency saving. So people need to do for their emergency. Now I'm going to discuss the case study 5, that is regulatory constraints in India. So, regulatory constraints, saving mobilization in India. So, what is the regulatory framework for this? NBFC, MFIs cannot accept the public deposit under the Reserve Bank of India regulation. The restriction protected the small servers from the fund misuse. So, in this case, why Indian microfinance institution faces the restriction on accepting the public deposit? RBI regulation exists to the protect small servers, prevent fund diversion, and maintain the financial stability in the system. Because MFIs cannot directly mobilize the deposit, they use legal alternatives like SSG, saving structure, cooperative societies, and partnership with the bank. These compliances approaches allows the institution to promote saving while following the regulatory rules. The challenges is balancing consumer protection with the innovation so that the financial illusion continues without the risk misusing of the fund. These all for the regulatory constraints in India. So now I'm going to discuss the case study 6, which is our last case study. So the case study of saving versus credit, which matter more. So as we all having a doubt on that, that is saving versus credit, which is more important for us. In this case, compare two villages. One phased mainly on the credit and another is using hybrid saving credit model. The hybrid village experienced low debt, stress and the better crisis management. Savings have lower risk, higher sustainability, and the strong long term impact compared to the credit alone. The credit without saving increases vulnerability while savings reduces over the indebtedness and the promote responsible borrowing. The hybrid model prevails because it builds reliance, encourage discipline, and improve long term financial sustainability. They key lesson in the credit should support saving, not replace it. So why the hybrid model prevails? The hybrid model prevails to reduce the over dependency risk, build the financial reliances, and so on. So in the product comparison, if we do the product comparison for the asset saving and the credit, to aspect risk level in the saving, we are having low risk level and credit having the high risk level. And sustainability is the high risk level and the credit having the medium risk level. Long term impact, saving having the high risk level as the credit having a medium risk level. And the vulnerability reduction saving having a strong risk level and the credit having the limited risk level. That's all from my side related to the case studies. Thank you so much.